TV18. This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. It's a Friday morning. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Good morning.
Coming out of a holiday, going into a holiday. Can't complain.
It's the best feeling, right?
Can't get better than this, right? 18 days and you have 10 sessions where the markets will be shut. So you're working only for 8 days from yesterday, I'm calculating, till April 16th. Good data point, right?
Yeah, absolutely, Nigel. The best, right?
And today's the IPL.
But we should keep these holiday data points under the radar, you know?
Someone asked me on Twitter the other day that you guys celebrate holidays so much. Do you even love your job? I said you can love your job and celebrate holidays at the same time, right?
Absolutely.
All right. Well, the markets are looking a little calmer, right? I mean, I think that is the key takeaway from the last 2 weeks. And that's good news. I mean, we're ending this week in a much better fashion. Sentiment is on the mend. There is no big news flow. And the point is, when there is no big news flow, it's good news. No news, at least no major news, is good news. That's the way to look at the markets out there. So, since we were off yesterday, we got 2 days of data points to react to, and it'll come up on your screen, the change. The S&P and the Nasdaq. The S&P is up almost 2%. The Nasdaq is up a little over 2.5%. So we'll react to this morning as we start. Global sentiment, as I said, is a little better because of nothing new in terms of banks, etc. No new crisis to resolve, etc. I mean, at the margin, there is this news of the FDIC how they saved SVB and the fallout, and maybe banks in the US will have to take a bit of earnings hit, and we can talk more about that later, but nothing large, no major news flow. What is also reassuring, and I think today we will markets will pay more and more attention, Europe onwards, to this data point which came yesterday. The latest weekly data point from the Fed's balance sheet and money market data indicates that things are again on the mend. I mean, so what does this mean? This basically means that number one, the borrowing from the Fed, banks borrowing from the Fed, both from the new facility and the discount window, is at elevated levels, but it is not rising. So that is one. And the money market data is basically money moving out of everything else into the highest rated, most secure government bond funds, money market funds, etc. That outflow is still there. Money market funds, AUM, is at the highest ever. But again, it's not accelerating like it was over the last 2 weeks. That would have showed risk aversion. So again, these two data points are also incrementally a little positive. In the near term, coming to the market here, on Wednesday, we finally got a decent rally, which stuck all the way till 3:30, did not get sold into. And I think we got a fairly decent tailwind of 2 days worth of rally in the US, up move in the US, not a big rally, but a decent 2% kind of move. So the near-term resistance, the levels remain the same. The average has changed. 17,207 is the first one. It's about a little over 100 points away from where we left off. And the 20-day now stands at 17,219. So that 17,220 kind of level, I think, is the hurdle to cross. It's the short-term kind of risk reversal to cross. On the way down, low of 16,913, which is the low from day before yesterday. The day before yesterday, 2 days back, the trading session 2 days back, that is the low, 16,913. It's an important level to defend on the downside. Again, very near-term levels here. Bank Nifty on Wednesday tested the 20-day moving average, but we did not close above it. So the 20-day becomes the near-term resistance. That's 40,047. And then you get to the swing high of 40,201. So again, on the upside on the Bank Nifty, on the downside, 39,273 is the level to kind of defend. These are all within 2%, 2.5%, 3% kind of levels, but that's near-term for you. Now, mid-caps and small-caps are the other part of the market which did very well. I mean, they rallied, and decent rallies after almost 9% and 7% cuts on the small and the mid-cap part of the market in the last 15 sessions. And we had 1.5%, 1.75% kind of rallies. And for both, I looked at the small-cap and the mid-cap index. The 20-day moving average is very close by. They're just 1 to 3% away. For the small-cap index, the 20-day is 3% away. The mid-cap index is about 1% away. Crossing this level again in the very near term adds to the confidence that perhaps there is more to go. But the important thing once you cross it is to stay above it and not fall under it, as has happened for the mid and small cap indices fairly recently. Sonia.
Oh, absolutely. And there's so much to watch next week, right? There are many big triggers for the market. So ahead of that, it's good to see that the bulls are making a slow comeback. And today, this morning, the SGX Nifty adjusted for the close yesterday, is up almost about 30 odd points. So the indications are that the start will be in the green by 30 points, and then we'll take it from there. The foreign investors have made a comeback as well. It's been 2 days now of buying that we've seen from FIIs. So yesterday, FIIs bought to the tune of about 1,250 odd crores, on Wednesday, I mean. And, Wall Street has shown some amount of resilience. I think the banking concerns have eased a bit. So across the US, across the European markets, there's a lot of green that we've seen. Brent crude is also back above, almost above $79 a barrel. Some demand has come back there. So global cues have stabilized. Now, for our own markets, we're holding on to the 24th March low. So the March lows of 16,930 seems to be a bit of a line in the sand for now. And as I said, there are many big triggers to watch out for. You have the auto sales that come out tomorrow on the 1st of the month, and it's not going to look like a good picture this time around. The footfalls have slowed down sharply in some of the sectors like passenger vehicles. Two-wheelers, there's no major recovery that's seen just yet. At least that's what channel checks and dealer checks indicate. So you could get a bit of ugly news coming in from there. Apart from that, next week is the RBI meeting on the 6th of April, and there's an expectation of a 25 basis points rate hike that could come through. So that will be in focus. There's also the earnings season that begins on the 12th and 13th of April. So you have Infosys, HCL Tech, ICICI Bank, all the large caps coming out with numbers in the next fortnight. So I'm going to watch all of that very closely. Also this morning, there's a very interesting note from Jonathan Garner of Morgan Stanley where they've upgraded India. We'll talk about that in greater detail. But the main premise on which they've upgraded India is they've said that the valuations are now looking attractive. The valuation multiples have narrowed. The premium has narrowed. So now they feel like this is a good time. And given that India was so resilient in this entire SVB issue, they are quite confident that things would look up. So I guess today you're wearing the right color for sure.
I hope I'm wearing the right. If it has some kind of rub-off, then great news, Sonia. But, it was good to see the last day of the March series. Well, the bulls fought back and they didn't go down without a fight. They put in a fight, they went down. The series went to the bears because we ended with the cut-off closure around 2% odd. The biggest positive, though, was the performance of the broader markets after the recent weakness. And now we are starting a new series. And the FIs, well, they're the most aggressive net short at the start of the series from whenever I can remember. So we'll get to that in just a bit. For the time being, though, we're talking about records at the start of this month. That's March. And maybe, in fact, we won't see the fourth straight month where the Nifty ends in the negative. Well, that's happened. So records are meant to be broken. And for the first time in 20 years, we have the fourth negative month, unless today we rally 2%, which is unlikely to be the case. The last time we saw this was in 2001. And, in those 4 months, that's between June to September, the Nifty that time corrected more than 20% on a base of 1,100. So this time around, we've got away with a 9% cut. Well, it's not as bad as what we thought last time around. Now, the FI short positioning. Shorts are at around 91%, which is very, very aggressive on the short side. And just put up a reference point at the start of the previous series. Well, they were between 70 to around 80% odd. So now they're aggressively net short. I'll tell you what, if you get any kind of good news, you'll be actually thanking your stars that there are shorts in the system because they'll be forced to cover out. But let's see how that plays out. On the option side, 17,000 put and call, both of them very, very active. So it gives you a broad range, a 400-point range that you're looking at. Recent low becomes a support. The 20 DMA on the Nifty becomes a bit of a resistance, 17,220 odd. But what's clear is if you get the Nifty closer to around 16,900 odd, then risk reward favors you. And that's evidence. Just look at it. The last few sessions, if you got in out there, you've made some money out there. And the odds would be that 16,830 to around 16,850 does hold out. SGX Nifty is suggesting adjusted that you'll be up close to around 30 points to kickstart trade. Need to build onto that. And for the Nifty Bank, we're very, very, we're at a very important mark, the 20 and the 200 DMA. You like it to break those levels decisively to give you a further trend. We had a bit of relief rally before we went into that holiday. So that's good news. But for me, the biggest point will be, was that a flash in the pan with regard to the broader market performance after the kind of selling? Or can we see more in terms of broader market buying? Over the next few days, I think it will tilt towards more buying in the broader markets. Valuations as well have become very attractive in select pockets. So let's see how this plays out.
All right, Nigel, thanks very much for that. But before we start and go any further, let's quickly tell you what is lined up in the first half hour of the show. We get you updates from markets across the globe. Dean Kim of William O'Neill and Company will join us to discuss the global setup. Later, our research team will get you CNBC TV 18's list of top 10 stocks for the day. At about 8:30, we do a fundamental stock analysis. Aditya Suresh of Macquarie joins in for that.
All right, we have a lot of important calls coming through this morning, so let's get straight to it. On the equities front, we have Hiren Ved of Alchemy Capital who says the market is temporarily oversold, though April is expected to be better, but don't expect any runaway bull market as yet. He adds that the market could spend a little more time in consolidation and investors should wait for Q4 earnings and management commentary. They are awaiting details from the technology managements about IT spends before taking a fresh call.
Okay, well, let's get you some money market views. On the rupee, Kunal Sudani of Shenoy Bank says the German annual inflation slowed sharply in March but still remained above forecasts, adding pressure on the ECB to further tighten its monetary policy, which pushed the Euro-USD pair higher and in turn dollar index lower, where 101.6 is an important support. He adds, the US core PCE index data, which is due today, will be crucial for the US dollar bulls. For the rupee, 81.8 to a dollar acts as a support, while 82.35 to a dollar is a resistance.
And also, let's get a view on the bonds. Ajay Magnolia of JM Financial says the announcement of the first half borrowing calendar by the RBI for the next fiscal is as per market expectations and is a balanced one across maturity buckets ranging from 3 to 40 years and shall be a comforting factor. It does match the demand dynamics across the curve and yields may remain in positive territory today despite tighter liquidity. As it's the last day of the financial year, there could be a last moment buying from long-term investors to rebalance portfolios. He expects the 10-year benchmark yield to trade in a range of 7.26 to 7.32%.
All right, we have plenty of stocks that we're tracking for you, and we'll get to the stock-specific action in just a bit in our special Top 10 segment, but we're looking at Reliance Industries, Oro Pharma, Cipla, Bharat Electronics. You have JSW Energy, Tata Power, Jain Irrigation Systems, and Maharashtra Seamless. They'll all be reacting to positive news flow in the last 48 hours or so, while you have Lupin and Max Financial. They are stocks that will be reacting to negative news flow.
All right, those are views coming in. Dean Kim